Welcome, everybody. My name is Jeff Fowler. I'm with the Apartment Owners Association. It is great to have you with us today. Thank you for joining our learning culture here at AOA. We have our phone lines open, ready for any feedback that you have for us because we want to learn and we know that you want to learn too, and that's why you're here. So thank you. There's a lot going on today. We have a 1031 legislative update, and there actually is an update. And so you'll hear that. And then also we have Franco Simone coming live from San Diego at noon. So you'll want to be in the room for that one as well, because he's going to tell you how to prepare for a small claims court. And hopefully you won't have to attend that. Hopefully you've been getting all of your rents and everything's cool. But if not, then you can join that one and he'll help you get ready for that. And so there's always things going on. We'll have John Capal coming and talking about how we can reverse Prop 19 from last year. That's one that kind of got by everybody. And then, there's why AOA has renter's insurance in the lease agreement. And so we'll have somebody come and speak about that. And so there's lots of stuff coming up. Subscribe if you haven't already. But what we want to do here at AOA is keep you in the know and bring you people that are in the know so that you can be so that you can learn from them. And just learning it's just so key. And one of the things that we do have here at AOA is tenant screening, and you need to learn as much as you can about your prospective tenants. And the price is going up $1 on just about everything there. So I did want to mention that. But for $16.95, November 15th, it's going to go up. But $16.95 will get you a criminal report, Social Security trace with the address history. It'll get you 2 different eviction reports, 2 totally different companies, and we give both of those. And for really the price of one, what others would charge, and then plus the credit report. So you get a ton for $16.95. And right now it's $15.95. Anyway, so that's one thing that we offer. There's tons of different things that we offer, and I don't want to bore you, but take too much time. I want to get to the meat today. If there is closed caption for hearing impaired, and if you want that, you can go to Facebook, and everything is closed caption there, and you can get it. And so we just want to let you know about that. And there is a blue help button at the bottom. If you're on AOAUSA.com, there's a help button. If you click on that, you can put questions in, and we'll be able to answer those. But listen all the way through, because you may have your question answered before our speaker is done talking. And so our sponsor today is Inland Securities. And these guys are really one of the foremost companies in the industry. They've done, $4 billion in DSTs over the last 13 years. And so this is the sponsor for today's live stream. And the speaker today, he's vice president since 2008, and he's responsible for sales and new broker relationships. And he's going to bring to you a great update and fill you in on DSTs and answer all your questions. It's my pleasure to introduce to you today Charles Jensen.
Excellent. It's great to be here today. I appreciate you having me on the webinar this morning. And it's I got some great updates for you. The goal of today's presentation is to kind of talk about, legislative update really fast, who Inland is, and also talk about 1031 exchanges as well as Delaware Statutory Trust. So I'll start off by just kind of, introducing our presentation utilizing DSTs in a 1031 exchange. Let's start with talking about Inland first. First, the risk, we'll be talking about a security today, the Delaware Statutory Trust. So read the memorandum and make sure you know what you're investing in. Inland was founded by 4 Chicago teachers back in the 60s. These 4 teachers met in teaching school, and they realized they're going to make about $6,000 a year teaching school. So they had the solution was to get together to buy some real estate to supplement their income and be able to go to Disneyland, go and travel, do different things. So they got together and they taught at the same school because it was easier. Back then, there's no Facebook, no Instagram, no cell phone, stuff like that. So they got a chance to get together and buy real estate. So their first piece of real estate was a piece of land. And since it was a piece of land, they call themselves inland because they're in the land business. They went on to buy more and more real estate as other teachers heard about their successes. What happened was they stopped teaching school in 1967. In 1968, they incorporated. Through the 70s, 80s, 90s, 2000s, and until today, they bought retail, office, industrial, apartments, medical, storage, you name it. By 1989, those four former teachers became the largest owner of Walmart nationwide. Kind of a rags to riches story. The best part of the story is today, all four of those former teachers are still there. One is the head of sales, the head of acquisitions, the chief legal counsel, as well as the chairman and CEO of the Inland Real Estate Group of companies. So it's quite a great success story. And today we are the eighth largest property owner in the United States of America, as well as we're the #1 DST sponsor in America. Year over year, last decade, we've been right around 20% market share, give or take over the years. With 255 sponsored programs, 120 completed dispositions, we're getting closer to 140 by year's end. We're at 5.5 billion in this slide, which is closer to 10 billion right now. So this is a really, great company. And in real estate, they say it's the three major things. It's all about, in real estate, it's all about location, location, location. In the DST world, it's all about sponsor, sponsor, sponsor. Who you invest in with is everything. It's very important. Make sure who you're working with has a proper track record. So I promised you a legislative update. Many of you that know Inland know that we have our own head of government relations, Senior Vice President Dan Wagner, who's on Capitol Hill. And we've done a few calls with the House Ways and Means Committee, as well as people that are associated with the upcoming bills. And I think you have all known the Biden administration has been talking about limiting 1031 exchanges to $500,000 per individual. This has been in the discussion as one of the pay-fors under reconciliation, right, to get the 50 votes in the Senate. Here's the thing that's happening as of late. About 3 weeks ago, the House Ways and Means Committee announced that the 1031 exchanges are no longer in the bill as of now, okay? So 1031 exchanges are removed from the bill. Secondly, the step up in basis is also removed from the bill, right? So when you die, your kids get a step up in basis to fair market value. That's out of the bill as well. But we do know what's under attack still is the capital gains rate going from 20 to 25%. Now we know that the sausage is still getting made. We do know that they're working together and they're trying, as they're doing these bills, a lot can change, right? But usually when you're taken out of the bill, it's harder to get back into the bill, if you will. Also, the size of this bill has dramatically decreased. We know that Senator Joe Manchin of West Virginia and Kyrsten Sinema, Senator of Arizona, also have some opposition to the bill, which is changing in time as well. So we're not 100% out of the woods. I say we're 95% out of the woods, which is a really good thing for 1031 exchanges and the step up in basis. So this is a great thing and a piece of information I want to pass along to you. Keep writing your congressman, letting them know that to not mess with the 1031 exchange. We don't want to let our foot off the gas, but as of right now, it's looking very favorable. And, until the bill is done, the bill isn't done, but we're out of the bill for the time being, which is a great piece of news. Again, back to Inland and who we are. Again, we're in almost every asset class of real estate across the board. We're in all but 5 states of the nation in almost every asset class of real estate. So I'm just going to go briefly over this 1031 exchanges in general, because a lot of you on the call already know this. But, why would you want to do a 1031 exchange? Exchange has been around since 1921. This is the 100-year anniversary of the 1031 exchange. And with that happening, we know that you can defer the gains on real estate if you go from investment property to investment property, right? So on $1 million, if you were to pay the tax and realize the gain, you run into 4 major taxes. The first one is depreciation recapture. IRS is giving you some tax benefits for the faucets fixed, all the things you can depreciate the property. You can offset your ordinary income, right? In this example, on $1 million sale of a property, this person received $100,000 in depreciation benefits. And there'll be a clawback recapture by the IRS at the sale of 25% or 25,000 on the 100,000. Also, you have the highest tax, the federal tax on the gain. So federal tax is 20% or $200,000, okay, on this. So that's the biggest tax you run into. State taxes. Now I laugh because we're in California. This presentation was made for national level, right? So if you take all 50 states, do the average tax, it's at 5.1% or $51,000. Medicare tax. But we know California is closer to 13.3 at the height, right? So look at 133,000 versus $51,000 in California. It's a much different scenario. The next thing is the Medicare tax, the Obamacare Medicare, 3.8%. That'd be $38,000 on the million. So on a national average, you're looking at $686,000 on average. In California, you could be closer to being left with $600,000 or a 40% hit potentially. Now, with the 1031 exchange, you defer your recapture, your federal state taxes, as well as Medicare. This is a great way to, defer your taxes, have the $1 million working for you versus the $600,000 working for you, right? The IRS, put the words together, the IRS, it spells theirs. Our goal in 1031s is to help you keep more of the money as yours. So one important thing is, you need to use a qualified intermediary. The funds cannot go into your bank account. You cannot take constructive receipt of the funds. They have to land in a third-party qualified intermediary. And there's 1,000 of them out there. There's a lot of title companies that have their own in-house QI, but it has to go to QI upon the close of escrow. If it doesn't, your exchange is blown. Second thing is there's a few windows. On the day of the close of escrow is day one. You've got 45 days in which to identify your replacement properties. And in exchange, you could sell one property and go into 3 new properties, right? You can go beyond 3 properties if you use the 200% rule. And then you have 180 days to get it closed. Now, the 45 days are calendar days. Today is a seller's market, right? You sell your property. A lot of people are getting multiple offers, 5, 10, 30 offers on a property. Easier to sell, harder to buy back in those 45 days. And that's one of the reasons why we're here today to talk about the Delaware Statutory Trust, because we pre-bought the properties. This may be a solution for you because we have pre-packaged opportunities for you in case you can't find something in this difficult seller's market. So again, the 45 days is much harder to hit than the 180, and we have a solution for you today. Now, remember too, the property, you can't just exchange any property, right? The property has to be held for investment or business use. So like kind means you're selling a property held for investment or business use and going to a property held for investment or business use. So there's a lot of different asset classes that qualify, right? You could be selling a raw piece of land, going to an apartment building, apartment to healthcare, healthcare to storage. You get it, right? Heck, you can exchange air rights above the building, mineral rights below a building, and water rights below a building. Well, there's something that was created back in 2004. It's called the Delaware Statutory Trust. And this is under Revenue Procedure 2004-86 of the code. This isn't something where there's a private letter ruling that might be flimsy. This is something that has tax code behind it in a full Revenue Procedure 2004-86. And exchanging to DST is basically a trust of one or more properties. And this is a vehicle, a trust that is considered like kind by the IRS. And exchanging to one is as easy as 1, 2, 3. 1, you sell your property. Inland doesn't do that, right? You sell your property via your realtor. Step 2, through the qualified intermediary, when the funds get wired there and the help of a financial advisor, you wire those funds into a Delaware Statutory Trust, which number 3, sell your property, funds go to QI, funds go to the DST. Easy as 1, 2, 3. So today we're limited on time. So I want to go over just the 6 major bullet points of a Delaware Statutory Trust. If one or more of these bullet points resonates with you, the Delaware Statutory Trust may be correct for you. So bullet point number 1, I want to go over with you as a salient bullet point is access to institutional quality properties, high quality properties. What do I mean by that? In a typical DST, most DST sponsors allow up to 500 investors. Imagine 500 people's money being banded together. We have my 100,000, which is the minimum for a Delaware Statutory Trust. We have your million, someone else's 10 million, someone else's $100 million. Times that by 500 people. Now we're dealing with hundreds of millions of dollars that we can buy in property. Maybe you're selling your apartment building for $1 million in Southern California, right? You're selling that $1 million property, looking for another $1 million property. In a DST, And that might handcuff you as to the quality of what you can find out there. In a DST, we can buy some pretty amazing stuff. So for example, I think we all know ESPN. Their headquarters in Bristol, Connecticut is an inland Delaware statutory trust. AT&T is an inland DST. A DST could be FedEx facilities, Amazon facilities, could be apartment buildings, hospitals, self-storage. There's a lot of different asset classes you can access. And imagine you're going from, a rundown duplex in Southern California into one of these types of properties. You've gone up in quality. Going up in quality brings safety to the equation. Number two, no management responsibilities. Now think about this logically. In a DST, there's up to 500 people exchanging together. Do you want 500 people trying to make management decisions? That was the demise of the TIC, right? 35 people trying to make decisions with unanimous consent. In a DST, we've learned our lesson, right? In 2004, they decided to allow the DST sponsor to be the trustee of the trust. We're essentially your property manager, right? We're handling all the management. On one side of a DST, you're losing some control, right? You're not doing the day-to-day activities. On the flip side of that, you're getting out of the management. And what would that be? The terrible T's, the tenants, the toilets, the trash, the termites, teenagers, taxes, TROs, all the terrible T's of ownership, you're out of. You're in a passive vehicle, right? That inland is managing. So for example, I have 3 different Delaware statutory trusts. Every first of the month, I get a monthly income direct deposited into my account on my 3 different DSTs. So I'll see my account balance jump up. Sometimes I forget because it's so passive, right? Every quarter, I receive an update on the property. Here's the financials, pictures of the property, and here's what's going on. End of the year, you'll get a financial statement from us, and you'll get an informational 1099. Now, what's happening here is I'm going to show you an example of a 1099. What's happening here in this example, this person owns in the top right-hand corner 2.7% beneficial interest in a Delaware statutory trust. In the first red rectangular box, you'll see they receive income of $77,808 over the year. So we're going to give you your income relative to your ownership. We're also going to pass on the interest expense, right? And the mortgage interest deduction to you. Here they're offset by $32,694. So this way you're not paying taxes on the full $77,808. You're paying taxes on a portion of it because we're going to pass on along all the depreciation to you. At Inland, we have an army of accountants working hard for you to depreciate as much as we can to give you as much tax savings as we can. You know that when you're deferring your state, federal, Medicare recapture, those taxes, the one tax you cannot avoid is the ordinary income that's on the property. And we can help offset it by passing on the depreciation to you. So if you're an apartment owner and you're claiming on Schedule E, you're still going to claim on Schedule E. We're just doing all the tax work for you, giving the information for you to plug back into your taxes on Schedule E to get all of your tax benefits. Simple as that. Monthly income, quarterly updates, end of the year, 1099. Very easy. And a rise on time looks like a K1, but a rise on time not to throw you into an extension each year. Step number 3, or bullet point number 3, is diversification. You've always heard the old adage, it's not good to put all your eggs into one basket. For that reason, it's great to put in a Delaware statutory trust 1 or more properties. So diversification is very key. And with diversification, it brings safety, right? So back to this slide. It could be at Inland, hypothetically, like an ESPN headquarters, an Amazon facility. It could be a FedEx facility somewhere in one DST. But typically when we do apartments, it might be 5 apartment buildings in Florida in one hypothetical Delaware statutory trust. This is just a hypothetical, for example. So imagine 5 apartments in Florida in one DST portfolio. Or imagine this, 5 hospitals in Arizona in one DST portfolio. Or 30 storage facilities in Texas in one DST portfolio. So imagine you're selling your one apartment building in Los Angeles, California, and you're splitting it on $1 million, a third into these 3 different DSTs. You went from one property in one city in one state. Now you're in 40 properties in 3 states and 3 asset classes. Are you diversified? I would say the answer is yes. Diversification brings safety. Try finding 4 properties in 3 states, 3 asset classes in 45 days. It's very difficult, right? Next thing is limited personal liability. We all know in exchange law, if the net sales proceeds of your apartment building is sold is $1 million, you need to go back into $1 million in real estate, equal or greater. You can take on more real estate through more debt or more equity. Anything less would be taxable. If you exchange from an apartment building that was $1 million into a property that's $800,000, the $200,000 you did not exchange, it's considered boot or taxable. Okay, you can do partial exchanges, but again, to get the full benefit of exchange, all the net proceeds need to go into your new property, equal or greater. Now, the IRS doesn't care if you're holding a loan. So let me explain this. Let's go back to that example. Now we add debt to the equation. You have $1 million apartment building, okay, but you have $500,000 in debt, $500,000 in equity that equals the $1 million. Logically, when you sell that $1 million property, you're left with $500,000 in equity going to the qualified intermediary, which gets wired into your next exchange. What the problem here is you need to get back to that $1 million. So most people have to take out a new loan for $500,000 to get back to the $1 million mark. Now you can come out of pocket cash, but most people don't have that much cash laying around. For that reason, the vast majority of people take out new financing. So here's what I'm trying to say. If you sold a property with 50% loan to value, you need to go back into a property with 50% loan to value, right? Equal or greater. You go to 60, 70, 80, anything less to be taxable. If you're at 25% loan to value, you need to go back to 25% loan to value, equal or greater. Now think about this. What I'm saying is you have to go get your own loan, right? And do the credit check and go through the whole financing option there. In the DST, it's too difficult to finance 500 people. Can you imagine that? And then trying to get loans for 500 people, it's like herding cats, right? Very difficult. So what we do, we're allowed through the 2004-86 revenue procedure, the IRS allows Inland to put one loan on the property, right? We go out to a third-party bank and get financing and put it on the property. With one loan on the property that's our debt, not yours, it's non-recourse, hence the bullet point, limited personal liability. And what we do is that we're allowed to allow you to absorb our debt as yours. So think about this. Here's what I'm saying. You don't have to go get financing or get a loan. You can absorb Inland's debt as yours. And the debt is non-recourse. It goes off your credit report. Your credit score should jump up, right? Because you're no longer holding that debt. You're absorbing Inland's debt. That's our debt, not yours. But you're also absorbing all the depreciation of that financing that gets passed along to you. That's going to offset your ordinary income, right? So think about that. You don't need a loan in a DST. You don't need financing. Don't need a credit check. You can absorb our debt. And here's what's great. Some of our DSTs have no debt. Some have 40, 50, 60, 80% debt. So imagine this. You need 25% loan to value. We don't have a 25% loan to value deal. You have a couple options. You could put half your money into property number one as a zero debt identification in a DST. Property number two can be a 50% loan to value apartment deal, for example. 0 and 50, you average out to 25. You can blend our DSTs to get the exact loan to value that you need. Let me show you an example. Hypothetical investor sold a $1.1 million property. They're holding a 45% loan to value. They're replacing into an Inland DST. Now, we went ahead and put 48.5% debt on this. Remember the rule, equal or greater? They're going greater. They're going from 45 to 48.5. They're not picking up more shares. They're picking up more debt. As you can see below, they're going from 1.1 million to 1.165719, 65,000 more in debt, which gives them more depreciation and more write-off. So you can use this as a play. Husband and wife own an apartment building for 30 years. It's fully depreciated. Your cost basis is going to follow you. In a DST, you could go into a 50% loan to value deal, get more depreciation to offset your ordinary income. That way you're keeping more money in your pocket. So if you're getting a 4% cash on cash, net of all fee income, it's going to feel more like maybe 5 or 6%, depending when you talk to your accountant and financial advisor, depending on your tax bracket. So this is a great thing to do. So again, no financing on DSTs. You can absorb our debt. This is a great benefit. Many of you sitting at home today probably have some sort of revocable living trust set up. If you don't have one, you should probably look at getting one, right? Because it helps you not to go into probate upon death, and it can give you some protections, right? You're allowed to put the Delaware Statutory Trust inside of a revocable living trust. So think about it this way: 2 scenarios, one without the DST, and let's say there's 2 kids, Bobby and Sally, okay, that are going to inherit this money. So husband and wife have an apartment building. You manage it the rest of your life, dealing with the tenant soil trash, or you're managing the management company. And upon death, your kids get to step up in basis, right? But now Bobby and Sally have this $1 million apartment that they inherit at a stepped up basis. Are they going to agree upon when to sell it? One needs money, one doesn't, right? One wants to management, one doesn't. Who knows? It allows a lot of areas for the kids to fight. Now, scenario number 2, you sell your apartment building. You go into an apartment, Delaware statutory trust to hedge some inflation, right? When you do this, you're out of the tenants, the toilets, the trash, right? You can retire from the real estate. And upon death, the kids inherit the DST interests, right? And what's going to happen is your trust might say each kid gets 50-50. So they're getting $40,000 a year on that million. Now they're getting $20,000 each divided by 12. And see, they can't get mad at each other. They're either mad at their financial advisor or inland, but not each other, thank God, right? So this is a neat way to pass on real estate. And when the DST is sold, they can, if it's set up correctly, they can each get their own interests. And they can exchange if there's a capital gain above the step up, right? So this is a great way to look at this as an estate planning. But also for a lot of you out there, it's an insurance policy. Here's what I mean by that. Earlier, I said you can sell one property and go into up to 3 properties in a Delaware statutory trust, right? Sell one, go into 3. Now, a lot of people, because this is a seller's market, are selling a property, they're identifying one property. That takes a lot of risk because if that one property falls out of escrow after day 45, you're out of luck. You're paying the taxes. Now, imagine this. You're identifying your one property on your own. Property number 2 and 3, via a financial advisor, they can identify inland for you free of charge, no obligation. And typically you can do this in 30-day in advance of your close of escrow. We're holding inventory. In fact, we have a good amount of inventory now and coming out in the near future. We've already closed on the properties, right? So you can absorb our deals. You can identify our deals as backup just in case you fall out of escrow. Or we are considered like kind. You can do a blend. You can do $500,000 on your own locally, $500,000 to a DST. It doesn't matter. Here's what I'm trying to say in summary. If you're looking for high quality properties, you want to get out of the management game, right? The tenants, the toilets, trash. You want some diversification for safety. You don't have to take out the loan or you can't qualify for a loan. You want to put in your estate plan, use an insurance policy, that DST might be right for you. And in closing, I'll leave my information up here. So you can always contact me and, also CC your financial advisor. We can help you find one if you need it. But here's what I'm trying to say. The Delaware Statutory Trust, we bought the properties in advance. We put the leverage on in advance. We've done due diligence in advance, right? All we have to do is pick through these like a menu, like when you go to a restaurant. I want the burger, I want the salmon, I want the steak, whatever. You're picking from it. You can identify these properties and we have inventory. So with that, I'll turn it back over to you to go into questions if we have any.
Great. Thank you so much, Charles. That was excellent. Thank you for the update and a quick explanation of the DSTs. That helps for sure. And yes, we will go into questions. Before we do, if this is the right time, the right season in life for you, and you are looking at selling, definitely consider the AOA brokerage. We've been around actually longer than the association has. And we have brokers here that have, all of them have at least 25 years experience, and they're willing to help you for sure. So yeah, go ahead and you can type those questions in. And also, whether you're going to stay in the market or not, if you haven't participated in this protest ever with us, I certainly want to encourage you to do that. And you can go to the AOA website, and right across the top, there's a banner, and it says join the protest. You can click on that, and there's a form there that you can just print it out, form letter, and you can send that to your city officials if you're in LA or Alameda or somewhere where you are still under the moratorium. We need to continue to let them know, give them the feedback just about what this is doing to the industry. And yeah, so all of us, we're all in business for ourselves, but yet we're in an industry together, and we can make it better when we do actively participate. So want to encourage you to do that. All right, so here we go. We have Charles, a question there. Thank you. And it says, is there a contracted maximum investment period?
There is no contracted management period. There's no sunset clause, if you will, that's put in the document. When you read it through and through, there's nothing that says we will sell in year 5 or year 7 or something like that. The reason is can you imagine if we contracted to sell it by a certain amount of time and it put us in 2008 or 2009, or it put us at the start of COVID, right? We don't want to get stuck in that. So there's not a contracted area of time, but typically the financing that's put in place on purpose It's a 10-year with, it goes into some hyper M after the 10 years. So it really pushes the sponsors to go full cycle within a 10-year window. And here's the thing. A lot of DST sponsors have never taken one deal start to finish. We've done it almost 140 times. So we've done so on an average of about 6 years. So we usually say have a time horizon of 5 to 7 years in your mind when you do a DST. Heck, I've seen deals go in a couple years, but I've seen deals go up to 10 years, if it's in a really bad market. And a lot of times, we're not looking to sell in a down market. You might be getting paid to wait until the market corrects itself. So when you go into a DST, I would say have a 5 to 7 year time horizon. Could be shorter, could be longer.
Great. Thank you for that. All right. Nino on YouTube. What is the net return on investment?
So your typical, there's two things, right? We're talking about here, the income and the outcome, right? The typical income on a DST is usually around 4%. You can find up to 5 in the market today, okay? Most of Inland's deals are closer to the 4% mark, give or take. And the reason is how we underwrite. We're all buying similar properties. So it's how we're underwriting, right? We put a good amount into reserves, which, doesn't get a lot of income, but it gives us more safety. We also underwrite very conservatively, right? So your typical income could be 4% cash on cash, net of all fees. A lot of times we speak differently in private equity world than we do as commercial and residential brokers. They'll speak in gross, we speak in net. So again, if you're being quoted a 5 or 6, taking into consider the taxes and everything else, the DST is inclusive of management fees, inclusive of a lot of these repairs and things. So it's a net of all fee income number. Historically, we know the past performance is not indicative of future results. And each sector has its own, returns over history. But, it's conservative. Some of our deals, we have 13 deals we're selling right now. I'm in one where we're hitting it out of the park, right? It doesn't happen every time, but it can happen. But on average, if you want to be conservative, let's say getting 4%, annualized total returns, 8%, 10%, it all depends. And again, we have some deals, we sold for quite a few times what we bought for it. There's other deals that are break even at that point, depending on the sector we're in. But the main point is you're not losing the upside. If we sell for 20% appreciation, you're getting your 20% passed along to you, right? Relative to your ownership. So you have your income, your outcome, your income, and those are growth, your total return potentials that are inland. And we do have some documents. If you want to email me, I can send you a document that shows you the averages of apartments and all the different sectors we go into. In fact, we specialize in apartments, storage, some industrial Amazon type facilities, typically, sometimes medical. We're in a lot of different asset classes, and I can show you the returns over the years through an approved document we have.
Great. And one other question that is there is Inland a public company?
Inland is privately held.
Yeah.
This is one of the reasons that a lot of people have never heard of Inland. You're in California, you think it's an Inland Empire we're talking about, right? We're actually in Oak Brook, Illinois, just down the street from McDonald's former headquarters. So we're privately held, which gives us more control of our company, right? Not being public. But you'll understand the properties we own, the ESPNs, the AT&Ts, stuff like that. One of the biggest owners of Walmart in the nation. We're number 2 behind the Walt Family Trust, typically. So again, privately held.
Great. All right. And so what we try to do with these questions is let one person ask one question. And then if we were at the AOA $1 million trade show or in one of our seminars, you would get to the back of the line and then everybody else would ask a question. So we'll do that in this one too. Here we have Clark, 5,700. Say I trade in and need cash after 5 or 10 years. How do I exit a DST?
Yeah. So if I were, I'm telling you all the great bullet points of a DST, right? But we know everything in life has its two sides to every coin, right? If you will. So what are the two sides on the DST? I'd say the biggest risks are illiquidity and lack of control, right? But in benefit, you're in a passive vehicle and you have a big company like Inland managing it for you. We have an investment committee at Inland that has some of our brightest minds on an investment committee. I think there's 7 people on that committee that make the decisions, right? When to sell, how to sell, and all that. So let's say I'm gonna make this up. Okay, let's say you go into Inland apartment deal. Okay, and X amount of years later, we say it's 5 years later, we sell it for 20% appreciation. just making this up. This is a fun hypothetical learning example. Your $1 million that you put in is now 1.2 million. That 1.2 million goes back to the qualified intermediary. At that point, you can decide to go back into a DST. At that point, you can decide to have the money wired back to your checking account and pay the taxes. In that point, you can also go back into real estate locally, or you can do all the above. Put 200,000 into cash, pay the taxes, put 500 to DST, 500 to local real estate. So really, you're in a lockup period, 5 to 7 years. If you're looking to put it just for a couple years as a holding place, this may not be the right vehicle for you, right? So you need to have that longer time horizon, even though it could be shorter. But then again, that's how you get out, right? And if you need liquidity, you think about it in advance. Think about if you need to cash out some to do some in advance to have a little extra money. But that's how it works.
Great. And maybe he's asking, can you get out prematurely? Maybe that's what he's asking. I'm just guessing on what he's asking you.
So if you read through 200 to 300 pages in any of our private placement memorandums, you'd find nothing that talks about a secondary market existing, right? That being said, if you're trying to sell, start of COVID, it'd be hard to sell. If you're trying to sell in February 08, it could be hard to sell. But that being said, is we're not obtuse to you finding someone to replace you, right? But we're not also obtuse to trying to be a friendly neighbor, and we send out, maybe in the statement that goes out, we send out 400 to 499 other people. It's a ream of paper. It doesn't cost us much to put in the statement that's going out anyways. Who wants to buy out John Doe's $1 million interest in the ESPN headquarters? Put your offer by this date, right? There's the thing. We don't have to do this, but we have done this in the past, right? That's what I'm trying to say. Maybe you'll find someone willing to give you a premium, or maybe they'll give you par, maybe it'll be a discount. Sometimes late at night, I'll go on Facebook Marketplace and try to lowball people on different things. I get bored. People do the same thing. They're going to try to lowball you, maybe, or maybe give you a premium. We don't know what they're trying to give you. So what I'm saying is yeah, we could help you out, but of the tens of thousands of investors, I think it was like 15 people last year, and I asked our back office that exercised this option. So you see, this is an emergency escape hatch that we don't have to do, but it's there. So again, you get the point.
Great. Okay, here we go on YouTube. Jay Price. How many portfolios of assets does Inland offer? And what is the selling process if you, we already took care of that one. Yeah. So how many portfolios of assets does Inland offer?
So we typically, because see, it's like a closed-end fund. When you go out and buy the property, we have 100 million in equity that gets absorbed by your equity, and that deal closes, we open a new one, right? Inland is one of the largest companies in the game. So we have the buying power to go out and buy our next deals in advance. We're holding our next apartment deal storage typically in advance. Some markets are harder, like today, where it's harder to find inventory, right? But we typically have on our platform some sort of apartment deal portfolio. We typically have a storage portfolio at any given time. We typically have a medical deal, not as much lately, but every now and then we'll have a hospital. We typically have an industrial, like maybe an Amazon facility. You might run a situation where there's a couple weeks lagging where we don't have an apartment deal, a couple weeks lagging, we don't have a storage deal, right? But what I'm getting at is if we're in communication with you and if your financial advisor that's working through the process, we kind of have an idea of what's coming out. We also know what's out, and we know the velocity of the capital, how fast it's going. So our typical deal will maybe last for 30 days, if less in today's market, but we have a lot of inventory that's out and coming out at any given time. I'd say we have probably a minimum of 3 deals typically at any given time. But again, they're getting sold out, new ones coming in and out, so that number changes.
Great. All right, let's see. Susan in the chat in San Diego. How about a 1031? How about 1031 a commercial property worth 3.5 million carries no note free and clear? Example, please.
Yeah, so 3.5 million, and you're holding that free and clear. So it sounds like a pretty specific example. And again, feel free to email if you need more consultation, we can bring into the mix. But in that situation, let's say you have that 3.5 million, maybe you want to put, a third of it into an apartment deal, maybe a third into a storage deal, maybe a third into an Amazon deal. We can make diversification happen for you. In that situation, again, assuming 4%, it could be less, more, depending on the property, you could be getting 40,000 for every million, right? So in this situation, you might be looking at 70,000. Is that about right? I don't have my calculator in front of me, No, wait, sorry, 40, 40, 80, 12, 130,000, 140,000, give or take. Sorry if I'm doing math on the fly, but you get an idea, divided by 12 months. So we can make that work for you, right? We can help you build a portfolio and give you a lot more income that you can get out of state, right? Because we know in California, the average person is lucky to get maybe, 2-3% net of all fee cash on cash income. And we know at 3.5 million, I'm doing the calculator now. You'd be looking at almost $140,000 a year, right, in income. $40,000 a year. You divide it by 12 months, you're looking at 11,666, assuming a 4% income. That's net of all fees. So remember, that's net of all fees. Maybe you're getting 14,000 now, but you've got to figure out your expenses looking at that. But if that's what you're asking, that's how it would look. And sorry for my fuzzy math a second ago, on the fly, trying to do it in my head, but you get the idea that we can get you a nice income stream.
All right, here we go. On YouTube, Armida, how and who does manage the maintenance cost?
This is a great question. So you know how we call it cash flow, and we're not saying it's cap rate, right? We're buying at a cap rate of X. We're paying out at Y. We have a spread between what we're earning and paying out. There's a little bit of cushion. And this is what makes our distributions somewhat solid, is because we have a cushion. And what's happening is every month, there's a portion of that cushion, that spread between the cap rate and the cash flow, that's going into a reserve account. Every month, we start with a certain reserves, and it's building and building and building. Now, for your portion, your share, you're going to get that back at the end of the deal, right? But that money in that account can go to support the distribution if necessary. If the market is a downturn, we could use it. We could use it for upgrades, to put $3,000 to $5,000 per door to an apartment unit, right? To do some value add. But also we have it there just in case something happens, right? Because you cannot have a capital call in a DST. It's one of the benefits. But also, of that spread between cap rate and cash flow, we have our management fee. Usually around, depending on the property, 2-3% of the gross rents, right? And SoCal, maybe you're paying 5-6% on the management. Your management is built into that spread. So technically, you're not paying anything above what we quote you on the cash flow. We quote you 4%. That's 4% cash on cash net of all fees on $1 million. That's $40,000 a year, or $333 every month of the year going out. So again, the management fee, 2 to 3% off the gross rents, is built in to the number we quote you, if you will.
All right, thank you for that. And then John, thank you. If you own a building in an LLC with one other partner, is there a way to split into individual ownership after entering into a DST?
Yeah, so here's the thing about LLCs. We know if you're holding ABC LLC, that the entity needs to remain. If you're selling from ABC LLC, it needs to go invested with ABC LLC. If you break apart these entities, it can trigger the IRS, right? If you don't wait a couple years. So usually people will wait 2 years in advance, break up the LLC, and then invest, or after, those kind of things. But there's 1,000 solutions here. And again, feel free to reach out on a specific case. If we can help advise you, we have a great team of individuals, including the qualified intermediaries, that are experts in entity issues. This is a whole subject. We could probably do a 5-hour seminar on this. But in LLCs, if there's 3 members, all 3 people usually have to agree to make the move. This is the problem with the LLC, but there's ways to do this. A lot of times people will exchange into the DST with the 3 members, and then they'll find ways to buy each other out after they've exchanged in, you see. There's a lot of ways to do this. You can go to 3 different DSTs, right? That are held in that LLC, and then break apart later. Because again, if you try to dissolve the LLC in advance, it could trigger the IRS going to your exchange. So again, this is a longer discussion. I would say reach out to us, the experts at Inland, to talk to you about your specific example. Bring in our experts and outside experts to talk to you about your specific situation. But it can be done. You can be pulled apart, but it takes some work.
Great. That's a good answer, I think. Ram, and when you trade off the property in 5 to 7 years, can it be exchanged for a REIT?
So typically, a REIT is considered stock right? And stock is not exchangeable. So typically you cannot 1031 exchange into a REIT. However, there's something out there called an UPREIT or an umbrella partnership REIT, or they call it a 721 exchange. Now, I get a lot of people to say, oh, I really want an UPREIT. What's the advantage of an UPREIT? You get liquidity after 2 years in an UPREIT. What's the disadvantage? It ends your exchange journey. Imagine going into a stock, and if that stock is tanking, you're handcuffed because you have to pay the tax. So again, you get liquidity, but you can never exchange again. Your exchange journey ends. Now, people that do this typically are older, and it's their final exchange. They have no errors. They don't care about the step up, whatever, right? That do this. This is kind of being sold to a lot of people as the end all be all. It really isn't. But think about it this way. This is really where an UPREIT could be nice. You got $1 million and you need liquidity. You need $100,000 that you have access to. Put $100,000 of the million into an UPREIT. Put $900,000 into a DST, and now you have some liquidity. You see, that's a proper way of using an UPREIT. So you could go into an UPREIT after the DST, technically. In fact, we'll probably have one at that point. But you get the idea that make sure it's right for you, because it's sold as the answer for everything, and it really isn't. Because in a DST, you can swap until you drop, defer until you die, change over and over and over, and have the optionality to cash out every time it sells. The UPREIT doesn't give you that. So,
great. All right, back to Nino. Can you exchange out of a DST using a 1031 or by any other means?
Absolutely. Because every time we sell a DST, we send you a letter with hopefully a 60 or 90-day close of escrow notice saying we sold it to this entity for this amount, right? What happens is now you got those 60 days, 90 days to figure out your next move. Now, we always default those monies when they're sold into a qualified intermediary, because we don't want to force you into a taxable event. So it's a lot of liability there, right? So we have you go back into the QI. It's like the movie Groundhog Day, where he wakes up every morning and it starts over. You got another 45 days to identify, 180 days to get it closed. So you have a lot of optionality in this. And every time we roll a deal, you can roll into another DST, you can cash out, you can go into a local property. So that's really your optionality. And you can exchange over and over. Because again, remember, DST is like kind investment. You go from any like kind to any like kind. You go from a DST back into an apartment building, apartment to raw land. You can do whatever you want to do amongst these asset classes, as long as it's held for investment or business use.
Great. All right. And Nino, one more time. Would you liquidate how would I liquidate my interest in the DST, and what would the cost be to me, if any? I wonder if that's the same question, or what do you think?
Yeah, if we were to go back at that answer I said earlier about, saying a letter to the investors, we're not necessarily charging a fee for that, right? That's kind of done as a courtesy to help, marry two people together to say, hey, this person's selling, this person's buying, right? Which we cannot guarantee a secondary market will exist, right? But when we go to sell a property, in private equity world, there's usually an 80-20 split on the profits, right? Where 20% goes to inland and 80% goes back to the investor. Not in DST world. 100% of the profits, and you go back to the investor. Now, DST sponsors can charge a disposition fee. Referring to fees, there could be a dispo fee on the back of the deal. Inland has typically not taken it. We could take it, and by our private placement memorandum, it's up to 3% if we choose to do so. Sometimes we don't take it just to be friendly and want you to go back into our next DST. So it just depends. We could take it, we could not, but we have typically over the years not taken it regularly.
Great. Well, I think we finished all the questions here. And for all of you that have joined us, thank you so much for being a learner and hopping on this live stream with us. At 12 o'clock, we will have another live stream with Franco Simone, who's a landlord-tenant attorney based in San Diego. He writes the legal Q&A for the San Diego issue of the magazine, and he will be sharing how to prepare for small claims court if you need to get back that COVID-related debt. So you'll want to tune in for that if you have a need. And just about every week, we're going to have something for you. John Capal is going to be speaking in a couple of weeks about how to repeal the death tax that was passed here in California, that Proposition 19, sneaky 19 that got through. And and then we'll have one about renter's insurance. And, that's part of just about any rental agreement that's out there. And definitely the AOA rental agreement has the provision in there where the tenant has to have renter's insurance. And you'll see, so we'll have a live stream about why that is and really the benefits for you, benefits for the tenant of having that. And so you'll want to listen to that. And anyway, let's see, we have one more from Jay Price, and just fee structure.
Yeah, fee structure. So this is interesting in a Delaware statutory trust. And think about it in a lot of ways and when you're selling your apartment building, right? So let me give you your example of when you sell your apartment building. You might be paying 2 or 3% when you go to sell the property, right? Buyer and seller to the realtors. So that could be up to 6%, right? When you go to sell. Let's put another percentage point in there for ancillary fees and financing, whatever is going on inside the transaction on the front of it, right? So for you might be around 7% in fees when you go to buy and sell a property, right? In a Delaware statutory trust, it's a little bit more. At Inland, it can be upwards around 9%, give or take the deal that we're in. But think about it this way. When you put, say, $1 million into a DST and say it's $40,000 in income over the year to the penny, every penny you gave to us is paying out that 4% up front. Technically, you're not going to fill that fee until the back of the deal. In fact, your first statement will show $1 million. Second statement will show $1 million. Third statement, $1 million. It's never going to change. It's not going to change up or down. But when we go to sell the property is when you'll feel it. So if we charge a certain upfront load, we're gonna recoup that on the back technically. But you're kind of able to compound with that monthly income stream of all your money working for you, which will help negate some of that fee. But every DST is a little bit differently. So read your prospectus. Usually in the first couple pages are all the fees. And by the way, in the DST world, Inland is one of the lowest fees out there in the DST world. One of the lowest fees. And again, one of the biggest managers of these DSTs and creators of the DST properties. Bigger is better in DST world, in my opinion, because if you don't want to work with two guys in a pickup truck. You want to work with people that have a big company. They're able to sustain something that jumps into our purview, so.
Cool. Well, thank you everyone for joining. And yeah, please remember that if you're an AOA member, you can tack on to your AOA membership before the end of the year, and that'll save you some money instead of waiting to renew after January 1st when the annual dues go up. And anyway, hope to see you at noon with Franco Simone. And again, thank you, Charles, for your expertise and giving us a little information. I think now everyone knows, okay, if you want to, you can go directly to the Ways and Means Committee. You can go there and you can see that. Do you have if they just go to US Gov, is that where they would be able to find that?
Yeah, they'll be able to find it over there. We were given a document that shows, what was taken out, what's left in and all that. But yeah, you should be able to find it if you were to Google this and look online. But again, don't take your foot off the gas, like we said, right? Keep the advocacy going because this bill isn't done yet.
Right. Very good. Thanks, everyone. We'll see you later today. Bye-bye.
Thank you.